So this is where we get some more interesting stuff, where we may be going. Okay. So, just in case, put on the life vest. Everyone else is just pretty happy. He's got the life vest on, just in case. So I used to do this presentation, we called it lifeboat drills. And what a lifeboat drill is, and I'm going to forget, so I'm going to grab my notes here. What a lifeboat drill is, a long time ago, is what do we do? What do we do if we're, am I in the right spot now? Okay, good. What do we do if we see, not that it's possible to see, but if we think, not that it's really possible to know anything, but what if we say, we think there's a correction coming? What do we do? This is a question, this is not rhetorical. Do we sell and go to cash?
No.
Absolutely not. Why not?
Because it might not come and you'll miss the up.
And what happens when you sell and go to cash?
You
pay taxes. Right? If you have a taxable portfolio, you pay taxes. Okay. So what do you do? So, say it again?
Buy.
Well, after, yeah, not before, after. You buy always. That's the thing, is you always buy. Okay. So the first thing you want to do, you think something's coming, you tighten your belt, right? You see if you can't reduce some spending, just in case, because that one doesn't hurt your portfolio, right? Second thing you do is maybe you stop dividend reinvestment, right? Maybe you take, your plan calls for, and you have a plan, right? Your plan calls for $3,000 a month of savings. You actually have freedom of $5,000 a month, and right now you're investing the additional $2,000. Maybe you stop investing the additional $2,000 and pay down debt with that instead. But you keep putting in the $3,000. You keep putting in what your plan calls for. Boost your emergency fund. Review your risk tolerance. And I don't mean change your risk tolerance. I mean, look at what your risk tolerance is and what losses you've said you can stomach. If you wonder what your portfolio is, call, ask, we'll talk about it. I think your downside is this. Worst case scenario, you might lose 30%. That's not for anyone specifically, don't freak out. Call and we'll talk about your portfolio, how it's designed, what your potential loss is. And we'll see if it's right for you, because now's a good time to do it. You want to do it now, you don't want to do it after, right? You want to do it now. Everyone's that has a plan, we've done this already, but if you have a question, this is a perfect thing to talk about. And the last thing you got to do is you got to rebalance your portfolio. So we do reallocate, right? We are constantly looking at where the value is. I'm not reallocating because I see danger necessarily. I think about it, but I look for value. So I'm going to shift towards things that have more upside potential long term. So one of the reasons the market is so highly valued right now is because you have to put your money somewhere, right? And we've talked about it here, where if you were a 2-year treasury investor 5 years ago, 10 years ago, you got a 4% dividend. Now that's 1 point something. And so you might say, I need that income. I'm gonna move to a 10-year treasury or a corporate bond, or maybe I'll buy a dividend-paying stock. Or that person might have said, well, maybe I'll buy a growth stock, or maybe buy a little bit of growth stock, or maybe I'll just shift. So everyone that had expected a return shifted towards more risk. Okay, so is that the right way? No. So we have the lifeboat drills, but so I still have a lot of optimism. So we talked about that, the Shiller ratio, the CAPE ratio, right? So just looking at it a little bit longer term, looking at the context of it, it's actually not that overvalued. And this is what's happening in the world. This is sort of a heat map. The places that are green or dark are growing at over 2%. So we haven't seen this for a long, long time. We have a synergy of growth globally. Europe is the worst, but they're improving the fastest, and the value is there. That's why we like that. That's why that's attractive to own. But when you have this kind of growth, I mean, you have earnings going up, you have, human earnings going up. You've got people coming out of the middle class, you've got people getting healthcare, buying shoes and jeans for the first time. You've got so many things are happening that are positive for the companies that are selling goods and services into the world, that this without some outside shock, it's difficult to stop this. it will stop at some point. But the valuation isn't as bad as we thought, and the global economy is just doing really, really well. Let's imagine that, I don't even know some of these countries. So let's imagine, Bangladesh has spices and India has rugs. And it's just a matter of, we have spices, you have rugs, we're trading. They're trading with each other, and it's creating GDP for them. It's not massive. So there's an expectation that in 2018, China will slow down and then pick back up again. So we saw China was the leading emerging market country last year. There's an expectation that in terms of GDP, they're going to slow down. They've got a couple things they've got to fix. They've got to fix their debt levels. They've got to manage their relationship with us. And that's going to be a challenge for them. The debt levels are going to be a challenge. Okay. Remember Grexit? Now we have Brexit. It's kind of the same drawn out. They'll talk it to death and it'll be a big thing in the headline. And at the end of the day, it won't matter that much. So let's say that there is or isn't Brexit. So they'll lose 2% of their GDP for a period of time, and then it'll right itself. And that'll have very little global impact. The attitude that they've had will hurt them for a long time because banks are leaving and they're just not going to have it anymore. They're not going to deal with it. They're going to go to Switzerland or go to Germany, and it's too bad. But it doesn't affect us that much. Oh, but innovation. Innovation is huge. I don't remember where I was. I read that 90% of the data that's being stored right now was created in the last 2 years. Right? Think about that for a second, and now think about this one. Only 2% of the data is being analyzed. We have a long ways to go until we're looking at all the data in every sector and every industry, and there's enormous upside in that. And soon, let's think forward. What happens if we have electric cars? They drive themselves. It changes infrastructure. It changes energy needs. It changes parking. It allows for more green space. It changes so many things, and we are going there. We can't quite, do this until we're all not driving cars. You can't get rid of street signs until everyone is in an autonomous vehicle. So you asked, is there anything crazy out there? All right. Cryptocurrency is crazy. It's crazy. It's crazy. And someone's going to he's gone. Oh, I thought he was going to have an argument in place, but he left early.
It is the future of currency.
No. Anyway. Blockchain is a very important technology. Distributed ledger is incredibly important technology. So it's only good as long as people say it's good, as long as you can transfer it into something of value. So maybe there will be one that comes along that people all adopt, and it's now the universal, it's the earth currency. Maybe that'll be the one. I don't know, but what's out there right now, there's no guarantee of anything. It's pure and utter speculation. Still, the distributed ledger, where you validate both sides of a transaction and that stays in something that's permanent, that's interesting for security purposes and for any industry that requires registration of something. Real estate, stock certificates, it can change those industries drastically. So that's something we should pay attention to. So there's a lot of risks out there. This is how I think it goes down. Ready? This is my completely guesswork crystal ball stuff. So I'm very happy with the way the economies are working. That makes the Fed nervous. So the Fed is, maybe they're behind the eight ball, maybe not. Maybe they're doing it exactly like they're supposed to be doing it. But eventually we're going to see the Fed say, and in fact, there's a couple people out there right now saying they expect it this year. I don't know when to expect it. The Fed is calling for 3 interest rate increases this year. If the Fed comes out and says, you know what, we're going to do 4, that's a spooky moment. That's a moment where the confidence in markets will go down. So that sense we have of, hey, it's all up from here, will go away. But until that happens, and they're being very data dependent, they're being very careful, they're being very, but until they say, we're going to do more than we thought we were going to do, then we're okay. Does that make sense? The biggest risk out there is the Fed is going to raise rates faster than we anticipate. That is the return to a normal business cycle. This guy you've heard me talk about, John Hussman. I've quoted him many, many times. This guy went to went to a 100% invested but fully hedged position in 2008, and he has dragged ever since. And he's still saying the exact same thing. He has not made any money for his clients for 10 years. And he's still saying the same thing. One day he'll be right. One day he'll be right. We know that for sure. Candace Browning, B of A, Merrill Lynch. History suggests that some of the best returns come at the end of markets. That's why thinking it's a seventh inning is important. It pops out, it levels off, and then it pops again, and then it falls down. We are just at the beginning, I think. Again, I don't know for sure. I sense that we're just at the beginning of that next section, up section. Historical terms, it's stretched, but there's a lot of profitability. Earnings-driven bull market is inherently rational for fundamental equity investors. That's what we've been talking about. Earnings are up. That explains it. Rates are low. We have to put our money somewhere. Where do we put it? And this is one of my favorite guys here. This guy used to be the director of research at LPL. He moved to Schwab not too long ago. And this is, a great 2017, kicks off 2018 well. So far in 2018, I said this already, January's over, we've got a 5 or 6% print. That's a pretty good start to a year. I'm very happy. But none of this matters. The only thing that matters is your plan. Okay? So if you're wondering about the risk levels, if you're wondering about how you're invested, how a change in markets are going to be reflected in those portfolios, ask us. Talk to us about it. It isn't what the markets do that help us or hurt us. It's what we do in response to markets. The reason we have these events and the reason I'm glad you guys are here, and I wish everyone else would come, is because by having this conversation on a regular basis, the noise out there, the stuff, the newspapers that are always talking about how bad it is, they will overcome your better senses. You come here to get inoculated against the next 6 months of this stuff you're gonna be reading. Seriously. Not a joke, not an exaggeration. It's wrong because it's trying to sell something. It's wrong because it's paid to be catastrophic. Okay? Make sense? All right. So that's that. We're ready for 2018. I'm ready for more questions if you want to ask them. All right. Thanks, everybody. It was good. Cheers.